And it really takes the disciplined founder who believes in this N of one thesis that goes, oh, it is because everybody thinks this is a great idea that I should not do that. And I think if you can build the DNA into the org of building multiple products, experimenting, it's a fantastic strategy.
Henry, welcome to 1 to 1,000 podcast. Thanks so much for joining.
Thanks for having me, Erik. Super excited to be here.
So one of the things that we've gone into a few episodes of this podcast is the navigating the idea maze. You take a really talented entrepreneur, they're thinking about their next thing, they're in the on deck phase. Why don't we start with your journey, starting eShares and then Carta, and why don't you share a little bit about how you navigated the idea maze, and then we'll get into general principles for entrepreneurs.
Yeah, it's, a big part of it is I think a lot of founders have this idea of like, if I build this thing, it'll be really big, and they can kind of imagine what it looks like when it's big, especially when people think about network effect companies, right? Which the best software companies are usually network effect companies of some form. And they imagine, hey, if everybody uses this product, like it'd be amazing. This is how it works. And the part that many of them miss, and is the hardest part, is the initial wedge, right? What's the wedge that you get the first customers to, right? The N plus first customer is usually much easier. It's the first customer that's hardest to get, especially in these network effect style businesses. And I think it was Chris Dixon at Andreessen Horowitz that coined the term "come for the tool, stay for the network." And many of founders that work on the idea, go through the idea maze, think a lot about the network, but they forget the first step of coming for the tool. And if you think about Carta or eShares in the early days, we had this intuition that if you could issue the electronic stock certificate to investors, you would create this network effect of cap tables and their shareholders. But the hard part was actually, well, how do you get the first people to do it? And the unlock for us was you could tell the startup or the founder, hey, instead of paying $15,000 to your law firm to manage your cap table, let us do it for you for $1,000 or $500, so much cheaper. But in exchange, we have to issue these stock certificates to your investors. And they hated the idea. They did not want us to issue electronic stock certificates to their investors. They didn't see any value in that. But the deal was, the trade of value was, I will do your cap table for 1/10 the price, but I need to tell your investors about it and make them log into Carta. And then once that got going, that became the new standard where everybody started, now if you get onto Carta, and we told them you can't issue your stock certificates to investors, they would go, what? That's crazy. I have to. That's the whole point. But in the early days, that was not the point.
And so for founders listening into that, what do you think are generalizable principles of how, or what are ways in which they can apply that? Like, for example, someone building something totally unrelated to Carta, what's a similar analogy of, hey, they might want to build this big thing, but actually they should start here? Or give it another analogy of a business you've seen either do something similar to what you've done or an example of something that could be done.
A lot of companies, you think about like, what is the initial wedge, right? You look at like a Brex, right? The wedge was a credit card, but the vision was spend management, right? If I could get the credit card into the company, then I could see where all the spend goes, and I could help the CFO figure out how to manage the business. So the vision was this much broader platform. But Enrique was like, but my wedge into this company was a better credit card. And that's how most of these things happen. It's like there's some underserved gap in the market that the founder can exploit that nobody else has seen or taken advantage of, that gives them a beachhead into a larger market that they can grow out of. It's a classic innovator's dilemma. Any founder that hasn't read Innovator's Dilemma should, because it's really the theory of why startups exist. Every large corporation is better funded, has smarter people, has more resources, has more scale and distribution. They should squash every startup. So why would a startup exist? And Innovator's Dilemma explains why that's the case. And it's really because the economic model of these large companies don't allow them to exploit small wedges that exist in the world that then can be opened up. And that's why founders often try to start with really big ideas, struggle, because once you start with big ideas, the big companies are actually working on that. What you really want is ideas that are start small, but then once you get on the beach, become big ideas.
Yeah, Peter Thiel has talked a lot about that too, picking a market and then expanding the market. It's an unintuitive or paradoxical idea. You have another sort of paradoxical idea, which is there's a very standard startup advice, which is make something customers want, and something you've talked about in previous podcasts is, hey, if you focus on making something customers knew they want, well then there's probably a ton of competition there, and so you want to make something customers want but maybe don't know that they want. And so maybe unpack that principle a little bit and the how behind it, because if they're not telling you that they want it, how do you know, in fact, what they actually want?
Yeah, I think that's the real difference between sort of conventional product management and a founder. Conventional product management is ask customers what they want, write it down in a product specification, and then go build that. That varies from some version of consulting to custom software to eventually productization and so on. But Steve Jobs famously never had focus groups. He said, if you ask customers what they want, they'll tell you a whole bunch of stuff. But what they're really good at is telling you what their problems are, but they're really bad at telling you the solution. And so what you really want to learn from them is, what are their problems? But the real job of the founder, and what makes the founder a unique role, is that you can distill these problems into a unique solution that nobody has thought of before. If it was so easy to just solve their problems and do what they told you to do, it wouldn't be it wouldn't be a unique aberration to build a great company, right? Everybody would do it. That's not actually that hard or creative to do. So when Paul Graham says, build something people want, I do believe that. Like, you have to build something people want. The question is, how do you figure out what they want? And I think a big part of the founder journey is developing a deep intuition for the customer and understanding the problems that they're facing, and then developing a thesis of how you can uniquely solve their problem in a way that nobody's thought of before.
Totally. And what you guys were building early on was unintuitive in some ways, and in some ways so unintuitive that the venture market didn't get it, right? And you're hearing dozens of no's. And so talk about what you learned from that fundraising experience, either about the venture community in terms of how to evaluate opportunities that may not seem obvious, but might be obvious in hindsight years later, or just as a founder in terms of, hey, if everyone's saying no to this idea and there's paid to look at ideas, what does it mean about this idea? How do I still have conviction in it?
The feedback was really interesting. To some extent, that one of the problems we had in raising money for this early on was that investors had the curse of expertise in this market. They understood the cap table problem, and they said, "Oh, I know this problem. Lawyers solve it, and it's not that big of a market. It's not that exciting and compelling." And so they really didn't invest, largely because they thought the market was too small. And it was actually also funny. Some of the investors would say to me, they would say, "Oh, this is so obvious a problem, right? It's like spreadsheets you should put in software. Why hasn't anybody done it before?" And there was this like weird dynamic where it seemed, for some of them, it seemed so obvious that they were scared off because they thought there was something wrong with it, right? It was too obvious, right? It was so funny. They would ask me, "Why hasn't somebody done this before?" And my response would be, "I'm the least qualified person in the world to answer that, because I'm the one doing it. Like, you should literally ask anybody else except me. Why? Because I think somebody should have done this before. It's weird that nobody has, and I get to be first." And so I think for us, it was really a market size problem. Was why many of the investors passed initially, and I think a curse of expertise problem. What I think many of them probably also, and I think we didn't quite understand, is we're also on the verge of a boom in venture capital, right? So they probably were right. If you looked at the world as it was when we did our seed round in 2013, it was too small a market, but that was the beginning of this market expanding dramatically. They also, I think, what we also didn't realize is that there's a big difference between a market can be very valuable, even if it's small, if you are the dominant player in it, because then you have pricing power in that market. And that also helped us expand the TAM quite a bit. A third of our revenue comes out of our fund administration business. And I think that will actually continue to grow as a percentage of our revenue over time. So you can see us diversifying. Like, we're not going to get to $1 billion of revenue in cap tables. We're going to have to expand for sure.
One of the other sort of unintuitive or contrarian insights embedded in Carta is this idea of turning unloved service businesses into beloved software products. Why don't you unpack this strategy, how it works in Carta, and how maybe other entrepreneurs can think about potentially incorporating in their businesses?
Yeah, I would say that's our playbook that we run best. We love going after services industries that sell a commoditized product differentiated only by brand. And so what that means is like things like cap tables. In 2013, 14, cap tables were managed by law firms. It was a commodity, right? You can't manage a cap table better, right? You either do it correctly or you don't do it correctly. But you don't pay more and you get a better cap table, right? It's either right or wrong. And once you get it right, there's no such thing as a better cap table. And so it's a commodity. It's services. So it's law firms that were doing it by hand. And it's only differentiated by brand. There's no difference between a Cooley cap table service and a Wilson cap table service. It's just one's called Cooley and one's called Wilson. And so we love that because we could enter that business saying, hey, we're going to do cap table management for you. And we'll start even as a service. Our first employees were like paralegals doing cap table management, but we'll bring software into the equation and we're differentiated. And so suddenly you're now differentiating in this undifferentiated market with technology, and your competition is services. And that's a wonderful thing because one, technology, if done well, can usually beat services. But also two, if the market standard is services, you get to charge services prices. Labor is inflationary, but software is deflationary. Labor costs, wage costs always go up. Software prices go down. It's hard to make money because, software prices keep going down because the marginal cost of software is zero. But if you're competing against software, you can charge what it costs a person to do it, but you get to do it with software. And so you get to make huge amounts of money doing it. So we did that with 49A. It's exactly the same thing. We saw the 49A industry. It was all services. It was $5,000 a 49A. We went ahead and said, hey, we'll do your 49A. We've got 49 analysts, but ours will be better because it'll be tech enabled. We can do it faster, better, cheaper. And the comp was people. And so we could charge human labor rates for software costs. And then we did that in fund administration. And anytime we see these industries with high labor prices that we can automate, we love going into them.
How do you think about incorporation through this lens? Like a startup incorporation, like what Stripe Atlas was doing? Or
Yeah, we've always took the view that incorporations is tough. It's a tough business for a couple reasons. One is you're trying to find a customer that by definition doesn't exist yet. You have to find the customer before they incorporate to get them incorporated. So you're looking for this customer that doesn't exist yet. And then when you do find this customer, you're finding them at the time that they have the least amount of money. How do you build a business on that? And everybody that tries has to figure out some way to monetize it over time. So the incorporations business is always a loss leader for something else, right? It could be a loss leader for legal services or registered agent services, or for Stripe Atlas for credit card services. And so everybody's doing some form of incorporation is the tip of the spear for customer acquisition for a bigger business. We've thought a lot about doing that. Our view was, instead of competing in that very commoditized, crowded space, we would just be the second stop. So a startup incorporates, and then they come to Carta, and that we would just partner. So we partner with Atlas, we partner with First Base, we partner with all the law firms. We don't compete with them. We don't want to compete with our own partners. We want to be the helper that after they incorporate their customer, then we can help them with cap table management. So we've always stayed out of the incorporations business.
Hey, we'll continue our interview in a moment after a word from our sponsors.
Are you building a business? Well, if you haven't already been asked by potential customers or investors about SOC 2, ISO 27701, GDPR, or HIPAA compliance, you will be. Achieving compliance can unlock major growth for your company and build a foundation of trust, and Vanta can help. Vanta automates up to 90% of compliance work, getting you audit ready in weeks instead of months, and saving you up to 85% of associated costs. Vanta scales with your business, helping you successfully enter new markets, land bigger deals, and earn customer loyalty. Bonus, for our 1 to 1,000 listeners, you get $1,000 off Vanta. Just go to vanta.com/1000. That's VANTA.com/1000.
Is Pave an example, the compensation tool, an example of a company that kind of followed your playbook, or a product that you in theory could have built? Or are there other products out there that are like, hey, they're following a similar playbook, I mean, somewhat adjacent or different space?
I think one of the challenges a lot of startups have in the last couple of years is, I would say, Zenefits, Parker's old company, Parker from Rippling. His last company was called Zenefits. Started around the same time we did at Carta, and we were probably the first two companies to reach $1 billion market cap selling to other startups. And then Zenefits had some issues, and I think they recently got sold. We were fortunate to keep going, and I think we're the only company that really could build a $1 billion plus business selling to other startups. And I think that created this perception that you could build other B2B software businesses selling to other startups that would be really big. But I actually go back to our earlier conversation about the early investors that said, how big is the market for cap tables? What they were really saying is, how big is the market for startups, right? How big a company can you make selling software to other startups? Because first of all, there's not that many of them that get funded. 2, they go out of business a lot. And 3, they don't have a lot of money. Like in general, I mean, these are, cash-starved companies, small cash-starved companies trying to make it big. And so how do you build a big business doing that? And I think there's a little bit of a challenge for these startups that said, hey, we're going to build a big company selling to other startups. And they're now starting to realize, like, that's actually it's really hard. I think Carta is this very unique anomaly that we were able to build business just selling into the venture ecosystem. There's no second place. Like, I can't think of another company that's anywhere close to tens of millions in ARR just selling to other startups. They all have to get out of venture capital. But many founders don't realize that. And they're like, oh, well, if Carta can build, a billion-dollar company selling to startups, so can I. And I just don't think the math works that way.
In the spirit of giving entrepreneurs other, advice on how to pick ideas, you're obviously, Carta's CEO through and through, and perhaps for life. But if in this hypothetical universe, you could no longer be CEO of Carta, and you had to pick a new idea or a new market just to inspire other entrepreneurs out there, or give them ideas. Do you have any requests for startups or places where you'd look that could inform people who are looking for ideas?
Yeah, I have a ton of ideas. I always tell friends, this Carta thing doesn't work out. This is the next company I would start. I actually wrote a blog post a couple years ago, 3 or 4 years ago, where I actually wrote down, I think, 5 ideas that I thought somebody should build. And I think actually one of them inspired Pave, 2 others inspired a few other startups, and so the bunch of them inspired a bunch of companies. And then I kind of learned a little by my lesson, because we decided to do some of these things, but I'd spawned some competitors on it. So I think the challenge we have at Carta is, I tell this internally to my teams. I said, we've got a lot of, $20 million ideas, products, businesses that could generate 10, 20, $30 million of revenue over, a few years. The problem now at our scale is that's a great idea for a seed startup. Like, that'll get you going. The problem at our scale is, unless we have line of sight to $100 million, it's not worth doing, right? It's a distraction for us, like to spend time on a $10 or $20 million idea. And so the mental thinking for me, that's kind of my challenge and journey now, is not to get excited about $20 or $30 million ideas and get distracted, but to stay disciplined on, like, I have to come up with 100, plus $1 million ideas. And that's hard. It's a whole new way of thinking at that level of scale. The ideas are very different. The way you think about $100 million ideas versus $10 to $20 million ideas is very different. And that's what I've been trying to focus on for myself.
Let's go deeper on that. How do you determine whether something, sort of the market cap for an idea, and when, what differentiates a $20 million idea from $100 million? Is it that you're reaching a new market, sort of new customer set? Or how do you think about, hey, this one has the potential to be 100, this one 50, et cetera?
A lot of it has to do with, market size and TAM and kind of all the conventional stuff. But when you think about ACV, when you think about like ACV of the product, what can you get for this product? A lot of these products are 5, 10, 15K ACVs. One of my investors said we were looking at a acquisition, and the ACV of the target company, I think, was like $5,000 or $7,000. And one of my investors said, and I said, I don't know if we can make this $100 million business line for us. And he goes, yeah, it's hard to, I think he said, it's hard to feed a lion shooting squirrels or something like that. If your ACV on a customer's is 5 to 10K, that's going to be a $20 million business unless you become like a massive SMB, machine. It's possible. There's a lot of companies that do that, but you really have to figure out how to do the SMB motion. And then if you're going to, try to get to, 100, 200, you've got to be able to move the ACVs up. For us specifically, because we only service, startups and venture, we either have to improve ACV or move outside of our sector because there's a finite number of customers. If you're selling to US small businesses, you could get away with a 5K ACV because there's, 10 million of them in the United States. But if you're selling to venture, you have to move up the stack. And so many of our ideas are how do we move outside of venture, or how do we move into higher end deals? So, for example, in our cap table business, we're $5,000 or I think we're $7,000, something like that. Relatively low ACV. It's a high velocity SMB business in our cap table business. But in our fund administration business, we're starting to move up market. We've got deals now in the pipe where it's $2.5 million, right? And that's like, you have to sell a lot of cap tables to earn $2.5 million. Where in this fund admin business, if we get it right, one deal is almost 2 months of cap table sales.
I'll walk through an idea that I've been interested in, see if we can apply your playbook. So I've been interested in this idea of, a lot of people have been interested. There's a lot of information in people's heads about how good other people are, and it's locked in. It's not on the internet. It's super redundant in terms of we do all these reference checks and then we just redo them all the time. And there's a lot of data leakage, and people hire people they shouldn't hire, and the best people don't get discovered, and this whole thing. And so that's the dream, is that what people think of each other to some degree is on the internet. And then there's a question of like, okay, how do you get that information? And I've some ways I've thought about include like a reference checks as a service business. If you're hiring an executive or a GP somewhere, hey, we'll do 50 references or whatever, and then you have that data forever. Or you become a full stack recruiting firm. You then get to your point about a service business, and then add software on top, and maybe you partner with other recruiting firms and say, hey, if you give the data that you've been accumulating, it's a sort of give to get model, and then anything to like sort of try to do LinkedIn endorsements, but done well. So there's different sort of layers of granularity of service to software. How might you approach this problem given your vantage point?
Yeah, so there's a company called confirmhr.com, or I think it's confirm.com now. I think they got the domain. It was actually started by Josh Merrow, who was an early Carta employee, and it's performance management software. But the thesis there is my performance reviews, my quarterly or semi-annual performance review, is that data owned by the company or is it owned by me? And so, for example, could I take my performance reviews from my previous employer and share that with my new employer, and they could read my performance reviews for the last 5 years of all the companies I've worked for? Or does it work more like a credit bureau, like the FICA, where I don't share it, but companies can pull my overall performance review, just like banks can pull my overall credit history to see what kind of employee I am? It's a very profound, powerful way to think about performance. So I think the world's, eventually will move there. it's fascinating that you work at a company for 5 years. There's all this data that's assembled about you in your performance and skills as an employee, how you work with others, and then it's locked forever. And then you get your next job based on a few hours of interviewing, and nothing that you did for the last 5 years is relevant. So I think that's a worthy problem to solve.
So yeah, using existing data sets like performance review, or there's a company called Searchlight that's trying to be the tool where people use to reference check. So if you're the tool, then maybe you get all the data, et cetera.
One of the other problems with all that stuff, we think a lot about this in performance reviews. We think about it in reference checks. Is when somebody says so and so is good or bad, whatever nuance goes into that description, how much of that is a observation of the person or the observer? In performance reviews, we call that idiosyncratic manager bias, right? When a manager says to an employee, advice or review, they're good at this, not good at that, easy to work with, difficult, whatever it is. When you read that, how much of that is truly a reflection of the employee and versus how much of that is a reflection of the manager? And it is fascinating how many people, and I'm sure you know this, right, can work with the same person and have very different perspectives. And that is it's so funny. It's so normal in everyday life, right? You have friends you like and people you don't like, right? But the people you don't like don't universally have people that don't like them, right? They have people who like them and people don't like. There's no universal perspective on people. And so one of the things I always say about these reference checks is how much is signal and noise. When I do a reference check on somebody, I actually can't tell, am I doing a reference check on the person or am I doing the reference check on the person I called, and what that person is like. I think it's really one of these fundamental questions about subjective performance.
Last question on markets. You guys are all about sort of this N of one market. Talk about what you mean by that and what advice you have for entrepreneurs to make sure that they're in an N of one market, or why that matters and how to find that.
When we think of N of one, what we really think about is competitive or non-competitive markets. So one of N means one of many competitors in the market, and competition erodes profit. This is the Peter Thiel thesis. To build a really valuable software company, you want to build what we'll call a N of one company where there's one winner in the marketplace. Because if you are the winner and there isn't competition, you have the ability to capture more profit. You have more price power. You have cheaper customer acquisition, and you're able to funnel those profits back to reinvesting in the business and building more product and propelling the company further, rather than spending all your time competing and fighting for mind share. And so we think about that a lot, where if we are going to enter a market that we think is competitive or will be competitive, and we can't turn it into an N of one market, we just will stay out of it. We'd rather take a small market that we can make N of one rather than go after a large market that's one of N. And that's actually rather counterintuitive, especially from a venture perspective, because when venture thinks about businesses, they'll often talk about TAM, and they'll say, one of the most common rejection reasons founders get from VC is the TAM's not big enough, right? And so startups always have to think of, well, here's the TAM. This is how big the market can be. But of course, you go after bigger TAMs, there's more white space for competition. And often the competitors are bigger, right? Like I'm going after databases, huge market, but lots of database providers, right? Very competitive. So when you think about TAM, it's hard to think about small markets. You often get pulled to bigger markets. And then the second thing about competition is we often pursue ideas that seem popular, right? So if that's why there's so many copycats. Everybody sees somebody doing something that's starting to work, and everybody does the same thing. They clone it. And so we're just, a mimetic species. Like we copy each other. You see it in fashion and, style and sports and like just everything. We try to copy each other. And you see that in business. We have this natural, whenever we see something working and a lot of people get excited about it, everyone piles in and wants to do the same thing. And it really takes the disciplined founder who believes in this N of one thesis that goes, oh, it is because everybody thinks this is a great idea that I should not do that. And that's the way we've always thought about things.
Hey, we'll continue our interview in a moment after a word from our sponsors. MetaView is the AI assistant for interviewing. MetaView completely removes the need for recruiters and hiring managers to take notes during interviews because their AI is designed to take world-class interview notes for you. The result? No more boring note-taking, so you could spend more time on what actually matters, being present with candidates and making high-quality decisions based on insights, not just memory. MetaView remembers everything about every interview, so you and your team don't have to. And unlike humans, MetaView never gets tired and structures its notes perfectly. Because MetaView gives your team perfect notes from every interview, you'll have 10x better hiring data about every candidate you speak with. Team builders at companies like Brex, Robinhood, Quora, and Replit say MetaView has changed the game because it lets them spend more time having high-quality conversations with candidates and less time writing up interview notes. See the magic for yourself for free in your first 5 interviews. Head over to metaview.ai/1000 to get started. That's metaview.ai/1000. I'm a proud investor. We've talked a lot about the idea. Let's go a little bit upstream. So when you've talked a bit about product market fit, and how do you recognize when you have product market fit, or what's your favorite litmus test for understanding, hey, how do we get product market fit, or how do we know if we're having it?
Well, my favorite story is we launched in January 2014. By August, we'd started, getting customers, and we had, back then people still called in to buy things, and we had a phone system. I can't remember what the phone system was, but we'd switched from one phone system to another. We misconfigured it or made some mistake where, normally it would say, press 1 to talk to sales, press 2 to talk to support, and whatever. And we made it so that when you press 1 to talk to sales, it would just automatically hang up on you rather than route you. And we still sold more cap tables that month than we had ever done before, which was consistent. We just kept selling more cap tables every month. But we didn't even know that we had done that for about 3 weeks. And the only way we found out was somebody went through the support line and yelled at one of our support people saying, hey, I've been trying to get through to talk to a salesperson to give you my money, and I can't get to anybody. Where are all the salespeople? And that's how we figured out that our phone system wasn't working. And that's when I knew we were onto something. When the customers are banging down the doors to get it, you've got something special.
To that point, you were just mentioning sales. Let's get into hiring a bit. What is the type of salesperson you should hire? What is your advice for thinking about? First, let's start on individuals as salespeople, or first salespeople. Then we'll think about the exec level.
So it depends on what type of product and company you're building. So I'll sort of break it out into two types of companies or startups. I'll call them innovation startups and execution startups. So the innovation startup, I'll throw eShares, early Carta in that category, is we're building something new. The world's never had before. So when we launched in January 2014, nobody had bought cap table software before. It wasn't that people had bought cap table software, but we had a better version of cap table software. So they knew what cap table software was. We were just coming and saying, hey, our cap table software is better. They had never bought cap table software before. They didn't even know what it was. They didn't know why they needed it. And a big part of the sales motion was to explain to them what it was and why they needed this thing that their entire life they never needed, right? They'd never bought it before. So why would I need something that I've never needed my entire life? And I would call that sort of this evangelical seller. In fact, in the early days, we didn't call them salespeople. We called them evangelists. And their job was really just to educate the market of what cap table software is and why it exists and why it's important. And that's like the innovation startup, right? You're bringing something new to the world, and you have to educate the world on why they need something they never had before. Contrast that to what I'll call an execution startup, which is really, they're building something new. So for example, if you're building a better database or a better payroll provider, you have a new, everybody's bought payroll before, everybody's bought a database. they know how to buy a database. They know they need one. Your job is just to convince them that you've got a better payroll solution or a better database solution. And so that's a much more conventional salesperson. And usually that's not a missionary. You don't necessarily have to find someone who's passionate, about, like in our case, cap tables. Like our first salespeople are really passionate about cap tables and changing the world. You need someone that understands databases and can explain to them why this new database that you've built is better than the one that they have. And they often tend to be not evangelists, but they often tend to come from industry. Right? You hire them out of industry from another database provider. They bring a Rolodex of people that they've worked with in the past. And they're like, hey, let me go back to my customers and say, look, I've found something better in the market. And I want to explain to you why this new database, that company that I've started working for, is better than what I sold you 10 years ago. And it's a very different form of sales.
Why don't you talk about the mercenary missionary framework more broadly in terms of what are the types of roles where you want a missionary and what are the types of roles where you want a mercenary?
Well, in the early days, you mostly want missionaries, if not only missionaries in the early days. As the company scales, it's harder to attract them. Asymptotically, employees just want a good job, right? Like when you're at Hewlett Packard and you're hiring the 130,568th employee, that person just wants a good job. They're not there for the mission of Hewlett Packard. But in the early days, you want these missionaries, and then over time, you find people that want a good job. We're at 2,000 employees now. We're somewhere in the middle. We have people at Carta that are here for a good job, but hopefully not that many of them. Hopefully, most of them are still missionaries and believe in what we're doing. But I think the combination of you do always want the core group of missionaries that understand the vision of what we're trying to accomplish and are driving the company forward. And then over time, some of the roles, not every role has to be a missionary. Sometimes you need people that just, are good at this job and want to have a good job and do a good job doing it. And that's great too. And so I think there's this balancing act over time where your core group of Carta employees or any large scale company, you keep the missionaries close to you as a CEO, and then the mercenaries start to fill in the gaps.
That's well said. Let's go back to sales. Why don't you talk about the first VP of sales and what you're looking for there, what to avoid, how to do that really well?
Well, our first VP of sales was Alessandro, and he had come from a competitor, so he kind of knew the space, but he was also a believer. He was our head evangelist, and he was fantastic. He now runs his own company called Dynasty that does trust management, but he built not only our sales motion, our sales team. He hired all the early salespeople that were all believers, and he trained them on how to educate the market. And he effectively created the market for cap table software that didn't exist. And if you find that, normally that's done by the founder. And I did a lot of that with him for the first couple of years, and then he took the baton and ran with it. And that's what you're looking for as a founder. Is the founder, I think, always has to start with that. One of the mistakes that founders often make is they hire a head of sales too soon because they don't like doing it. Because a lot of founders are product founders and sales is hard. And so they try to outsource it as quickly as they can because they don't want to do it. But it's so important for the founder to do sales early on. But once they get the motion down, it becomes repeatable. Then finding that person that can basically represent the founder in these sales calls and tell the same story that the founder does. That's the magic of finding your first VP of sales.
Well, let's talk about execs more generally. When you're advising founders who are starting to build out their exec team, what mistakes do you see them making, or what misconceptions do you think about how to think about building an executive team well?
Yeah, the early days, it's really hard. In the early stages for building an exec team, a lot of the call it the exec team at Series A, B. They're really just really good employees at their functions, right? You promote the best engineer to be your head of engineering. You promote the best salesperson to be your head of sales. You promote the best CS person to be their head of CSM, and then over time you start bringing in more professional types to help scale the organization. One thing that a lot of founders run into problems with is often the head of product, and they'll bring in a head of product to run product for them. Oftentimes, they'll bring in that person too soon, also, because most founders these days are product centric founders, and they have a strong opinion on product. And the mistake they'll make is they will bring in a product manager that they think is a vision product manager, right? There's sort of a few different types of product managers. I'll categorize them as vision product managers, which sort of are the inventors, right? The ones that kind of imagine what a product could look like. Then there's technical product managers, which often come from an engineering background that like know how to build the guts of a product. And then there's process product managers, which sort of know how to run a product process and just sort of manage. They're more like a project management version of product manager. And inevitably, what happens is the first product person that founders should hire is either a technical product person, if it's a very technical product that can help with the guts of the product, or a process product person that can just help get the product delivery org working. But inevitably, what they'll do is they'll hire the vision product person. And they'll do that because they resonate with the vision product person, because a lot of product founders are vision product people. So one is they'll often think they want a vision product manager because that's who they resonate with. Two, they'll have a really hard time finding them because first, there are not very many of them. Two, they often become founders themselves. And three, the ones that are out there, there's a big difference between a good one and a bad one, and they'll easily be seduced by the bad ones. And so they end up hiring a bad vision product founder, which gets nothing done for them. And they lost 6 or 12 months, and then they get burned on it. And what they really should do is be disciplined about saying, hey, I own the vision. I need a technical or process-driven product manager that can implement my vision. And that's their job. And that's the most common mistake they make on the head of product.
That's well articulated. We talked earlier about how market size is sometimes a limiter, and often in order for companies to be very big, they have to expand product lines. When is the right time to think about adding another product?
I have a different perspective than most. Most people will tell you focus on the one product. And I think that's probably right for most founders. For us, we were very quick at building new products and diversifying products. And I think if you can build the DNA into the org of building multiple products, experimenting, spinning multiple plates, it's a fantastic strategy. It's hard to do. So I think it takes a certain type of founder that can do that. But I think for most founders, the conventional wisdom is the right wisdom, which is like go deep, not broad. Find the right product, work on the product that's starting to work, get strong product market fit, and make that product better before you start distracting away from the core product to multiple products.
We're gearing up on time here. Is there anything we didn't get to that you think is interesting that you want to leave founders with as we think about one, picking the right idea, or two, scaling your team most effectively as once you have it?
I don't think so. You covered a lot of ground. We covered almost everything I know. This is fantastic.
Yeah. For people who want to go deeper, Henry has a fantastic blog and also video series on YouTube. And also you've given some great podcast interviews on Invest Like the Best, 20-Minute VC, and others. Henry, thanks so much for sharing your learnings with us here at 1 to 1,000 and for being supportive to us and what we're up to. Really appreciate you coming on.
Yeah, super. Thank you, Erik. Really appreciate you giving me some time.